Okay, so all right, we on Wednesday we are supposed to have the class which didn't hold because I had some extra activities that spanned into that time. So, uh, so today we are going to be having the class first. So, uh, look at some price action concepts. Then we'll now do our live session as we always do it, right? Okay, so the first thing I want to, can you hear me? And can you see the screen?
Yes, I can see your
I
screen.
can hear and see the screen.
All right, lovely. So the first thing I want to show you guys is the concept of trend lines, right? We call it trend line. So trend line is still useful in the market. Let's call it trend line, right? Okay, now, just like the name implies, trend line, it is a line that you draw to identify a trend or towards a trend. So if we have a market that is moving maybe in this direction, like this, and market is just forming highs, forming lows, forming highs, and so on, right? Now, this market can be referred to as a trend, upward trending market, right? Which is a bullish market. You cannot take a trend line and draw across like this. Now, your trend line, you make sure that it touches the peaks, which is the point at which the market is retracing from. The trend line is touching them. So this concept is still useful in the market. Why? Because we believe, or when you are using trend line, the assumption is when the market comes back to that trend line, it's supposed to bounce it back, just like it does. And if you see a trend, if you draw a perfect trend line on a trending market, that is good, right? You can be sure to take an entry from it. So if this trade should return to maybe this same point, it's going to now bounce upward again, right? Going to bounce upward like this, come another high, and we expect it to come again and bounce upward from another high, just like that. So as the trade keeps moving like this, we draw our trend line like this, and then we can now this line that is drawn at the bottom is the trend line. So how do we trade trend line? First, we trade the bounce, right? So we expect the market to come to the trend line and bounce back. So we are expecting a bounce. So what we need to do is when we identify the trend we have identified that our trend is a bullish trend. Then we take our trend line and draw it at the bottom of each of this trend line of this retracement to give us a trend line, right? Now, when we have this trend line, most times there will be fake out, like some candles will protrude and return, right? But once you have this, now we saw that, okay, the first one came here, bounced, second one came, bounced, this one came, bounced. So what we are expecting is, okay, if the market should come, we expect it to bounce and give us another high. So if we take our entry at this bounce, right, we can take an entry at this bounce, and then we'll take our take profit will be the high, this particular high, and our stop loss will just be below the trend line, right? And the market will come up, take out that high, and then when it comes back to bounce again, when we notice a bounce, we can take another entry, and then our stop loss will be at the bottom as well. Then we target the high again, and so on. So this way we can be following the trend upward. Every time the market bounces, we want to take an entry. Now, another important use of this trend line is assuming we took our entry around here, right? Let's say we took an entry here. and we are targeting maybe at this point. Let's take it a bit higher like this. So let's say this is what we are targeting. Our stop loss is just around here. So we are expecting this market to get to this point for us. Now the market started trending, so we drew our trend line. Every time the market creates a new low and bounces from the trend line and goes above this high, we now shift our entry, our stop loss to that point. So we take our stop loss to that point so that if we know that, okay, this high have been broken, so we don't expect the market to break this low unless they want to change direction. So we do the same. The market comes, bounces, then we put our stop loss below that point again, and we keep doing it and keep doing it and keep. So you can be shifting your stop loss to follow each of the breaks, right? Now, in as much as you are trading the bounce from the market, there is a point that the market will get to. It will be tired of going up and it will decide to break out of this trend. So now, what do you now do in this case, right? In this case, in this scenario where the market has broken out, you want to wait for the market to return to the trend and see that the market actually came back to this point, and the market broke this high, this particular high that this low that went for the retracement. You want to see that the market broke it. So if the market should break this low that came for the retracement, it means that the trend have changed. We are now anticipating a downward move. So what you need to do is to just wait for the next retracement to happen. So when the market gives you another retracement, you cannot take a short and start following it downward. So let's see practical example of what I just explained on the chart. And let's look for our trend. And okay, so this market is trending upward. So let's draw a trend line and draw our trend line like this, so you can see. So this is a trend line. So this market, this is a 1 hour time frame, and this market have been trending upward like this. Let's go it a bit. So okay, so now you can see from here that let's make it touch. All right, so you can see from this trend line, the move, this particular trend started here, as you can see here. This is our first point here, right? So the market started trending from here, right? So now what happened was that the market came high to this point. So all these points, they are still one move. There was a little retracement here. So it gave us this low. Now the market came back to this trend line. You can see it again and bounced back, right? So we expect the market that next time it comes to this, since the first point bounced and now the second point have bounced from the trend, we expect that if the market should come back to the trend line again, it should bounce. And if we are doing that, then our entry point, our target is going to be this high, right? We are going to be targeting this high to take our take profit. So the market came down to this point, as you can see here. Then we cannot take our entry here, and then we can target this high, and our stop loss will be just below this, just below it. Below it a bit like this. Now you can see what happened. The market came back to the trend line, bounced back. The moment we saw the bounce, then we took the entry, and you see, since we were targeting this high, it took out this high a bit, came. Now this time around, you can see what happened. The market came to this point and bounced, right? So if we were to take this entry, seeing this bounce, we could have taken entry here, and then we'll be targeting this high, right? We're targeting this high. Now you can see that the risk to reward is 1:1.6. If you see this one is 1:2. So this one, the risk to reward is very small, and it's not advisable to take trades like this that does not give you a good return. Because if you keep taking trades like this, the day you will hit loss, it will now impact in your account so much. So if we have taken this would have been a loss. And even if I was the one, I wouldn't take the entry anyway. Now, let's look at what happened. So the market came here, you can see, and another reason why you shouldn't have taken the trade from here is because the market, this move that came down did not actually give us a high. Look at this move. This one came like this, broke this high, you can see. So when it came, it bounced. So when it bounced, and the move that was coming was the high of the previous one, higher than the previous. So this one was also higher than this. So this is a high that came, but you can see the first retracement is trend line. So this retracement also did not break this. Let me show you an example of that. You see that here, this move came but did not touch the trend line. But when it came higher, it broke this high, indicating that there is still strength in upward direction. So when it came to the trend line this time around, we are confident of taking the entry because this behavior here showed us that there is still strength to go up. But if you look at this behavior here, similar to what just happened, this one it came, but it didn't get to the trend line, and then break this point. So this is indicating that the market is now weak. So it came and formed another low, which is lower than this one, even though a high was not formed. So even though it's giving us equal highs here, it's giving us low. So this is an indication that, okay, the market is beginning to be weak from going upward. And what happened, you can see when the market came to the trend line this time around, came here, it bounced, but could not break, came again, it bounced, it could not until it broke. So now that the market has broken this trend line, to take this entry now, we need the market to return to the trend line, and then we want to see that the market actually came out to take out this point of retracement. This point that formed the retracement, we want to see that the market actually comes back and take out this point. So if that happens, then we look for another retracement, and then we take our entry and follow the market downward. So the reason why I sent it for you that you should already take the entry for a sell is not because I use the concept of trend line. I used other concepts to get that entry. That's why I told you to use small lots so that you can withstand the retracement, right? All right, so this that you use it effectively, you will be shocked at the result that this single trend line can offer you. If you mix this trend line with some of the knowledge that you take profit 90% of the time. Now, if you like the market comes to your trend line and that gives you maybe a candlestick pattern that we have learned, that is already a perfect indication that, okay, the market is going your direction, right? So let's say the market was coming down from here, a bullish engulfing. That and it's at the point it's happening just at the trend line. Then you know that, okay, yes, you can take the entry and you target the previous high, the high that actually trended downward. You target it and get out of the market. And before the market will even if the market wanted to turn, you can see for you that hit your entry and you have left the market, right? So one of the tips you can use is what I explained, which is the concept of trend line, and you can use it for both bullish and bearish candles. This what a trend line is only effective in a trendy market. If your market is consolidating and you are trying to draw trend lines, you will be wounded because the market is not trending at that point. And if your market is not trending and you are trying to give force trends out of it, then your stops will continually be hit. For your trend line to be effective, the market has to be in a trend, and you have to be trading in favor of that trend, right? So, any question before we continue? Any question?
Yes, sir. I
Yes,
want to. I
there's
just
a
want to
question.
confirm. Okay.
Okay. Victor, go ahead. Ask your question first.
Okay, sir. The confirmation about this trend line is like to wait after like the first like the downtrend one and like as it's coming down, so you wait for it to retrace, come down again, give a break of structure to the downside, wait for the next retracement. Oh yeah, is that the confirmation?
Okay. So your question is this trend line, you have to wait for a break of structure before taking the trade. The answer is this. When you spot a trend line like this, you know, a bullish market is a market that gives you highs, higher highs and lower highs, right? Now, this market moved to this point because we can regard all these points as one move, or you can take it here, a retracement, and then this one. So now the market retraced. In order for you to take entry using your trend line, right? You want to see that when the market returned to the trend line, one, there was no volume, like there was weakness in the market. The market was weak when it was getting, so there was rejection at the point of the trend line number one. Then you want to also look for candlestick patterns, some patterns in that area. So if you look very closely here, you will see that there is a particular candlestick pattern that we have learned that is here. Who can identify it?
Tweezer button.
Okay. So you can see these two candles, you see that they have almost identical bottom, right? And almost identical top. And that is what we said concerning the tweezer, isn't it? So you see that when the market got to this trend line, it gave you a pattern. So the patterns that are formed in that zone is what will give you confirmation to take the entry. If you look at this other side that we took this entry from, you will see this other pattern that happened here. You see that the market came down and there was a pushback, like the week there was rejection. So what happened after that? We have a bullish candle that was bigger than this other one, which we can call engulfing. But even though the bottom is not the low is not lower than this one, you can see what happened here. So if we look closely, what you want to be using for your confirmation in trend lines is candlestick patterns, or you go to the lower time frame. So let's go to the lower time frame again to answer your question. In this case here, we could not see any pattern that we can use. So this is, you spotted the trend line in 1 hour time frame. So we want to go to a lower time frame, like 15 minutes, right? So we come to 15 minutes and we want to see what happened at that point. So at this point, you can see what happened here. Here we took the trade. You can see that the market came here and there was, even though there was no volume. So if you want to take this entry, you wait for this break, right? You can wait for the market to break this particular recent inside high, the lower high here, and meaning that you would have taken this entry around here. would have taken this entry around this candle that broke this point, right? So maybe this is the area you would have taken this entry, and your stop loss will just be around here, right? So this could have been your entry, because if you take it to the lower time frame, you see that this point stood as a resistance. So you don't want to take an entry that is still under this resistance. So you wait until the market breaks that resistance, and when it does, you take the entry, even because the market is now being pushed from the trend line. Now let's look at the one that failed. You can see the one that failed in 15 minutes. The market came, was rejected. The market could not form a high. So the market came again, dipped in, but was rejected and could not break this resistance that is already formed here. So the market broke this time around and came down. So now we are expecting the market to come down here, then take an entry to the downside, right? So if you come to your 15 minutes and you did not see any confirmation, you can also come to your 5 minutes and look for entry opportunities, right? So in these 5 minutes, you can see, let's look at the chart together. The point we took, here's the point we took our entry. This is the point, right? Let's see. So in 5 minutes, you can see that the market came down here, and then the market started moving upward with low volume. So since there is no volume in the market, you also want to wait to break the previous resistance, which is all these points. And then when the market did that, you see that the market started trending upward. So the confirmation that you need to use your trend line, it's not just that the market came and bounced, then you want to jump into it. You also want to look at other conditions, like, okay, this previous high, this particular point that formed resistance, will the market be able to break it? And the only way you can know is if the market actually breaks from that point. So you mark it, and the market break. The moment the market breaks, the candle that broke from the market, once it closes, you just take your entry from there and target this low that actually bounced from the trend line. Did that answer your question?
Yes, sir. Thank you.
Yes, Debbie, you wanted to ask a question.
Yes, sir. Okay, from the explanation you did the first time using the 1 hour time frame, I wanted to ask that how do you know, looking at the fact that okay, this market is like on is a current market. Now you want to take an entry from the place that is forming a new high. Probably it has bounced, it has come to that point, that's your line, and it wants to now go back. When you want to take your entry from there, how do you know how to place your take profit?
Okay, but I explained that. I explained it now. I said if you want to take profit, you should take profit from the high, the previous high that formed that retracement. So for example, if I'm taking the entry here from this point, you are seeing my cursor, right? This particular point like this. I want to take, let me close this. If I want to take the entry from this particular point, my target should be the highest point that formed that retracement, and that is going to be this point. So I'm going to just take my profit around here. So if I take this entry here, I'm going to target this high, and then my stop loss will be below that move, just a little below it, like this. So this is how you get your target. The highest point that formed that retracement backwards down to the trend line is your target. If you notice this one, the same thing, this is the highest point that formed the retracement downward. This is the highest point here. So we can take this entry here and then target that high. So this point becomes our target, this high that formed this retracement becomes our target, not higher or any other thing. Because the reason why you are targeting the previous high that came down is most times the market can get to that high and that high becomes a resistance to the market and the market starts dropping. For example, look at this one now. If you are taking an entry and this is your highest point, let's say this market actually got to the trend line right here, assuming it got to the trend line right here, and we took this entry. So now if we have taken the entry and we are targeting this high, right, then you can see what happened. That the market got to the high but never passed that high. So you can see the market got to the high and dropped. So just narrowly hitting your take profit, the market started dropping downward again. So that is why the most safest point to take your profit is the high that formed that resistance. So if you want to take your entry, you want to look, okay, where did this retracement back to the trend line start? And you want to mark it, okay, this is where it started from. So you put your line there. So when the market finally gets to your trend line and you have gotten your entry confirmation, you want to take that entry. So when you take the entry, this point of retracing back becomes your target. When you get it, you hit your take profit, you can either close for the day or wait for the market to come back to the trend line again. So in this case, you can see the market got to this high, retraced, you can take the entry again and you see that it got to that high and everything. So where you put your target is the previous high that formed that retracement back to the trend line. Clear?
Yes, sir, it's clear. Please, I have another question.
Right.
In a case where you have you're checking a chart and yes, you're looking at the trend line, but what you are seeing is not like this kind of consistent move. And you are also checking the previous trend of the market. You are seeing that the market has been on a low range for a while, and now suddenly this market has peaked and is going upward. At that point, you cannot really find like a trend of this the way it is right now. And now you are thinking of okay, how you want to enter the market or take your analysis in order for you to um, maybe mark out where you will take your wait for the market on top. I'm talking out of practically. I don't really know. At that point, I become a little bit confused because I don't know where to wait for the market really to now place an entry. Like okay, when it gets to this place, it will go upward, and then when it gets to this point, the market will definitely fall back. That's one question. Then number two, my other question is sometimes I follow this pattern of okay using a support, a resistance, and I find out that sometimes when it gets to that point of resistance, it's you now place an entry there, it breaks through, it goes a little, and it reverses. At that point, what do you do? Yes, I close the trade, but at that point, I feel like my analysis is wrong, or I begin to feel somehow. How do I correct that? Because I've experienced it.
Question. So if you have if you have been paying attention, you will hear me often say there's something called stop loss hunt, right?
Yes, sir.
Now stop loss hunt is what is happening to you, right? Because the market makers will not allow you to make the money just so easily. They want to trick you. They want to put many fake out. They want to put many incidents that will cost you to take entry, and then they will come and clean your money and add to what they have to drive the market. So this is what you do. I'm trying to look for a good example for you. So this is what you will do to solve that problem. First, the market is, let's say the market is trending downward, right? So moving like this. Okay. So then the market now formed resistance only, right? Now, this point that the market formed resistance is your point of interest. You want to wait for the market at this point so that you can take an entry. However, most times the market will just come to that point, break through it like this, then return backward and start going down. And it will even get above where you anticipated your take profit to be. So meaning that if you have not taken you out, you would have actually made good money from that trade. So this is how you can combat that. First, when you spot your resistance zone, you want to look if there are any other highs before that resistance, maybe a sharp move, or you call it order block, a supply zone or demand zone above that resistance. If you see a supply or demand zone, in this case, because this is a sell example, I'm going to be using supply. So now, if you see a supply zone around here, even though your resistance is at this point, this supply zone can attract the market to that zone. So it will cost it to break this zone. So when it breaks out from this zone now, it's going to clean all these stop loss, because many people have taken entry in this support resistance zone and their stop loss is just above the zone. So the market is going to look for that supply area and it's going to go upward, clean all the entries, all the stops that are here, tap on that supply zone and start dropping. So what you can do in that case is every time you spot a resistance or a support zone, look beyond that place and check, is there a supply or a demand zone? If there is any supply or demand zone, then you wait. Don't take your entry the moment the market gets to that resistance or support. You want to wait to allow the market to come back to that supply, clean that supply, then that is when it is safe to take an entry. So let's look for an example of what I'm saying, right? Let's look for a market that behaved like that. And we can use it for our example. Okay. So let me just, let's see. All right. I'm looking for a market that behaves in that manner so that I can show you. So maybe let's use a lower time frame. Lower time frame. Right. Look at the example here, right? These places, let's use this first example here. So you can see from here, we have support. There is support in this area, right? So you can see this is a support area. So we can draw all this, and then this is our support zone. So every time the market gets to this support, you can see that this is actually a support zone. So if we want to take entry from this support zone, we also take the entry around here, and then we will target maybe 1 to 2, and our stop loss is actually supposed to be just below the support, right? So now, if we took this entry, you can see what happened, that the stop loss was actually cleaned, and the market went far beyond where we predicted it to be. So how do you now combat all these challenges? And this is how you do it. First, now we have spotted our support zone. We want to now look, is there any move before this support was formed? Yes, this is the move. And the lowest point of that move is this point. This is the lowest point of this particular move, right? That now we now have support here. So we want to also check in between this move, do we have any kind of maybe supply or demand in this area? If we have a supply or a demand zone in this area, then that is the point we want to wait for the market, not this resistance, right? So if we look closely, we can see something here. This small, tiny, looks small, but okay, we can see something like in that candle. You can see that candle. So let's draw it. Let's draw it. And you can see there was actually a supply, a demand zone, right? Demand zone, or what you call order block. So we saw one hidden order block here. This was bullish engulfing. So the market already indicated that this is a buy market because this is engulfing. So now what we are looking for is this particular order block or demand. So since there is a little demand above, below the supply, the support zone, we are not going to look for take any entry yet until the market tap on that demand zone. So that was why you saw that this market actually came. If you want to take this market and be safe, your stop loss has to be below the demand zone. That is the only safety you can have. But if you don't want to have so much stop loss like that, you want your stop loss to be tiny, then you wait for the market to actually come and touch that zone. And you can see the market came, touched it, and was rejected, and you can see the push. Because every time market comes to a supply or a demand, it gains enough power to move towards the direction it wants to go to. So that is what you should be doing, right? Every time you spot a resistance zone, just put your this thing there, mark, look for any zone, how is it called, any supply or demand zone. If there's any, mark that supply or demand alongside this resistance, then wait for the market to actually touch that supply or demand before you now take your entry. Most times there may not be supply or demand, it's just the market hunting stop loss. So in that case, before you take any entry, you want to also wait for confirmation. Don't just take an entry the moment it gets to the zone. You want to also wait for the market to give you some kind of entry confirmation. So once it gives you that entry confirmation, then you cannot take your entry, and then you can just park that particular trade. Did I answer your question?
Yes, sir.
All right.
And my second question, you have not answered.
Yes. What's your second question?
I said when you are checking the charts and the previous market, you are checking the previous market pattern. You notice that the market has been on a low for a long time, and all of a sudden the market now started moving upward. At that point, you are checking where to put your take profit, because the market is on a high move right now, but no, because it has been on a low for a long time, nowhere to you put your nothing like another resistance here and all of that. So that market is just going upward like that. At what point do you say, okay, should you you want to enter this market, or you don't even know where to wait for the market so that you can take a bearish entry. I don't know if you get my question because
Okay,
I see
so
that.
let me understand what you mean. The market has been trending downward. The
And
market
not
is
really
moving
down
towards
range.
the market is moving
It has
towards a particular direction, right?
yes, sir.
And then suddenly there was a change in the trend. Now
No,
your
not change.
question is
No,
okay.
no, not in the trend. When you open the chart, you observe that the market has been on a range for a long period of time, and now all of a
Okay.
sudden there was a push, a buy market, and you are checking the previous chart in order for you to take your analysis whether to use support or use supply demand zone, but nowhere, because this is not like a new trend for a long
Yes.
time that is not happening. At what point now I don't know where to place my to take profit, or I don't know where to now wait for the market because it has gone up for it to now begin to retrace back for me to take a sell entry. At that point, what do you advise to do?
This is your question. The market has been in a range for a very long time, and suddenly the market took a sharp surge upward. Right, so this is the market has been in a range like this for a very long time, right? So this is the market ranging for a very long time. And then suddenly the market broke the range and started going towards a particular direction. And there seems to be a serious momentum towards that direction. Now your question is, now that the market has decided on a direction to go and a new trend is born, at what point should you enter that trade, and how should you set your targets and your stops? That's your question, right?
Yes, sir.
All right. So firstly,
When the market is in a range like this and the market breaks out of the trend, most times it can be faked out, and maybe the market wanted to sell, then it will fake to the buy side, and then boom, it will come down. But in this case, we are assuming that okay, the market actually want to buy, right? And now you are looking for opportunity to enter the market since it's already a bullish market. So this is what you do. First, since the market has already moved, you don't want to force the market, right? You want to let the market be. So you want to wait for the market at a zone, because every time there is force in the market left an imbalance that will later come and correct. It's called correctional candle, or you call it imbalance, fair value gap, order block, whatever they call it. The market usually, if there is a surge in move, that thing is always left behind. So the market will come for correction so that it can take all the orders that it was unable to take and continue that trend. So in this scenario, the market can leave maybe an order block or a demand zone inside this same range. So it can leave it inside this range, and then you allow the just mark it up. When after the market finish what you want to do, it will come back and then to start going up again, right? That is one way you can take this entry. And if you are taking the entry there, then you target just above this high, because since it's a new trend, you can just put your target above this, or you look backward to see if there's any point high that you can put your entry or you can put your entry above here, or just target 1 to 3, 3 times what you are risking, and put your stop loss below the how is it called, below this range. Under it, just put your stop loss below the range. If you are taking the entry inside, you see the order block inside the range, the market comes back and actually steps on that point, now gives you a confirmation of the movement to the upside. You took the entry, and then the market, you cannot put your stop loss here and target 3 times what you are risking. So how you can calculate it using these two. So you can just put it here and can drag. This is 1 to 3, right? So, but it's not here because our stop loss have to be under here. So when that, if that's the case, we just target 1 to 3, which will be around here, or you can target 1 to 2, whichever that is okay with you. Just target it, and you start breaking even. Every time the market forms a new low and breaks that high, the previous high, you shift your entry to the new one. Just like that, you keep pushing your stop loss until you now you have stopped out of the market in profit, or the market hits your take profit, whichever way, right? So this is one way you can take the entry. You wait for the market to come back to an imbalance that it created before that move. Another scenario, most times the market will not create an imbalance inside. So if the market does not create an imbalance inside the range, you want to mark this point, because this point will become a point of resistance to the market. So you want to mark this point as a resistance zone. So the market most times will just come back to that zone. Sometimes it will dip and then retrace. Then you cannot look for confirmation to take the entry to the upside. So these are the ways that you can combat such. So did you understand the explanation? Before we go, let me look for example for you.
Yes, sir.
Okay, so let me look for example and show you what I mean. Let's shrink the chart. Looking for a ranging market. Market that is in range. Okay, look at this Bitcoin range, right? Bitcoin was in range here for a very long time. This was the range. So this is a good example. If I shrink it, you'll see the range. So this is the range, and there's another range here. So we have this was the range, right? So you see that for a very long time the market was here. It didn't go out of it, right? So comes down, go up, comes down, go up. Even though it was forming some fake outs, right? This is why you cannot just enter the moment there is a breakout. So it's fake. You have to wait. So now there was a sudden break to the downside. Can you see the break? There was this surge move to the downside. And how you know that it's a valid move is the force at which, if you compare it to this one has no force. But look at this one, there was confirmed break to the downside, and the market kept going. Now, for somebody that is more experienced, who have been on the market for years, would have taken entry from here, because when you stay with the market for long, you master some behaviors. And even here too, you can take entry. But for beginners, right, let's say we don't even know if we should take this trade or not, because I mean, the market is just going and we are not seeing any point of interest to wait for it. And there was a range before this move. Now, what do? What we want to do is to look at where this break started. So the breakout started from this point, right? This is a point the breakout started. So you want to look in this area. Is there maybe any supply block? Is there demand? Is there anything of such? If you look at the last candle that formed that move, which is this, you can see it here. So we want to mark that candle as our supply. Is this supply zone now? Yes, supply zone. Or if you don't want to take, you can take this one at the top like this, right? You can take this, but this one is more recent. Or you can just mark the whole of this environment that formed this move. So now, since you have marked this, you want to wait for the market to come back to this place that actually formed that move. You want to wait for it. So two things you are looking for. One, you want to mark this zone, because this is now our support zone. Everywhere below this thing that refuse the market from going further inside this range is referred to as our support zone, right? So because it prevented the market from going further downward, so it's our support zone. Now that we have seen our support zone, we also want to identify the supply inside. So these are the two places we'll be looking for entry. So if the market should come to this zone, this our supply resistance zones, which was previously support to this move that is now broken, we want to look to take entry, all right? And if we are taking entry from here, we cannot put, so if, let's say we want to use this zone, so you can use this zone to take your entry. Then in this case, because the market has moved before returning, you know what to do already. Just target the previous high of the move, right? Then you can just put your stop loss above this move, just above the move. So you can take the entry using this technique, or you want to also wait, should in case this particular market wants to dip. Once they enter inside this your supply zone, you want to take entry again, right? So you take another entry and you target the move that actually came to do because so this is the low that caused that retracement. Then this time around, since your entry is inside, your stop loss should be outside, because it may want to probably play around and come on. So you put your stop loss outside there, and you can see for this one, we are having 3.5 times whatever we risk, and for this one we are having 4.11 times whatever we risk. And then just watch how the market played out. You see that the market came. After that, we took the entry, and then there was a massive drop, half close to our TP, but didn't get to it. It retraced back again, and then successfully dropped to our take profit, even beyond, and still going down, right? So these are the approaches you can use to enter a new trend that just formed after a long period of consolidation. You also want to wait for that market to come back to that point where the break has started, which can be either the support zone or an order block inside the trend, inside the consolidation rather. Any of them you are able to identify, take the entry, and then you'll be able to follow the trend towards the direction it's going to. Did that answer your question?
Yes, sir. Thank you.
All right. So, any other question? Okay, no other question. No question? All right. In the absence of any question, we'll be going to the live session now. Where you will be share your screen with us, right? So, we are waiting to start now. Who is ready for the live session?
Sir, I'm going to on our
Yes.
laptop also.
Yes, it's your laptop.
Okay.
All right, I'll be waiting. If you are ready, indicate that you are ready so you can share
Please,
your
my
screen.
laptop battery will not carry the live section. This live session.
Okay, so you are not prepared for it then. Yes, who is?
Let me on my laptop, sir.
All right. All right. Uh, seems like only one person is ready for this live session. So, all right. Maybe we'll cancel the live session and we'll continue on Monday. But please, on Friday next week, try to make can try to make your laptop available, right? Make your laptop available, then you are going to be doing I will send 7 different pairs into the group. Then each of you will analyze one. So I'm going to attach names to the pairs. So if I send a pair, I will attach your name to it. So that one will be the one you are going to analyze on Friday. So I'm not going to send it today. I may send it maybe on Thursday night or something. But I'm just telling you how I will do it, right? So
so that by that Friday, you should be able to analyze it for us using all the things you have learned, and then we'll look at the analysis together and make decision either to wait for the market to enter our points, or we want to take the entry directly. We will all make those decisions from the analysis we are going to make on Friday, right? It's all right. So that will be the end of the class for today. I will make the recording available for you guys so that you can refresh your mind on the trend line pattern. If you master the trend line, you can use only trend line to make a fortune if you master it. So there is no need of complicating analysis and all those stuff. Just simple thing that yield result is what you need. So go through it over and over again. And from next week, we'll be going into more advanced concepts. So prepare yourself as well and make your writing. I expect that you should be writing, right? Even though the video will be available for you, I expect you to be jotting down points, because while I'm talking, you may just get an insight in the process of talking. You can just jot it down, or I may say something that you just understood it in a way that you have not understood it before. Just write it down the way you understood it, write it down, and then you can go back to your book later, because you may listen to the tape later or the recording later, and you will not get that insight from it again. But it's always good to go back to the recording. Why? Because it helps you to refresh. There are times that if I have constant loss, maybe in a week, my trade is just hitting stop loss constantly, but I can decide to leave the chart and go back to videos that I've made, the ones I have used to teach people. I will just decide to refresh myself. And also the ones that I got from mentors, I will also go through them just to refresh and go back to my book to check that, okay, am I doing something outside my strategy, or is it the market that is just being the market? Or is it an unfavorable period for my analysis and all those things? So that's why I make the recording available. If not, I wouldn't be doing that. However, I will see you on Monday. Keep practicing. If you have questions, send them to the group, and it will be attended to. If it's a personal question that is just personal to you as regards the trade, maybe your account is having issues. If it's account issues, you can send it to the group if you are using the same broker with others. Those who have already know how to do that thing can just reply you what to do. Unless it's something that's private, then you can send it to my DM. If not, you can ask your questions in the group, so that who have the knowledge can just help you out instead of waiting for me all the time, right? It's okay. That will be all. See you next week. Stay safe and God bless you.
All right. Thank you, sir.
Okay, sir. Thank you, sir.
All right, sir. Thank you so much.